to start.
Okay. Shall I go?
Yeah,
Yes.
it says live.
Okay. Hello, and I'd like to introduce myself. My name is Robin Harrison. I'm Industrial Relations Officer at the BMA, and I'm here to talk to you today briefly about the new SAS contract and some of the issues that have arisen as a result of the implementation and the National Pay Award. I start here with the slide, just really introducing the BMA. Any of you who are not BMA members, we still have our first month free offer to the end of October. So if any of you are keen to join, please either log on at that email address, or I think there would be a QR code at the end, is that which you can scan. Anyway, so as I say, I'm here to talk about the implementation of the SAS contract. Going to talk a little bit about what contract you're on and what choices you have, particularly looking at the key differences between what I'm going to call the old and the new contractual arrangements, most particularly talking about pay, which I suspect is the main issue. What contracts are we talking about here? We're talking about anyone who is currently on a national SAS contract. They are most likely to be, you're most likely to currently be on either the 2008 specialty doctor contract or the 2008 associate specialist contract, which actually has been closed to new entrants since 2008. There may be some of you who are on pre-2008 national contracts, such as staff grade, hospital practitioner, etc. There will possibly be some of you who are on local grades, trust grade, clinical fellow, etc. The arrangements I'm going to talk about now do not automatically apply to you. That would be up to the discretion of your employing trust. And from 2021, there will be two new national contracts, or there are being implemented at the moment, a specialty doctor 2021 and the specialist 2021. So all new appointments to the SAS grades will be to one or other of those contracts. And I think the important thing to stress here is that the reopening of a more senior SAS grade, i.e. the specialist role, which is somewhat similar, I suppose, to the associate specialist role that the contract for which was closed in 2008. So I think that's an important win for the BMA in the negotiations. One of our key priorities was to reopen that higher grade. So what choices do you have? So if you're on one of the national SAS contracts, you can express an interest to move to the new contract which you're eligible for. And at this stage, that expression of interest doesn't bind you to anything. It merely introduces you into a process, the outcome of which you can then make a decision whether to accept the new contract or to remain where you are. So current associate specialist doctors can move to the new specialist 2020-2021 contract if you've met the entry criteria, which we anticipate that you will, if you've had no difficulties around appraisal, revalidation, disciplinary issues, for instance. Other SAS doctors, and we're talking largely here about those of you who are on the specialty doctor contract, can move to the new specialty doctor contract. Or, as I've said, you can choose to remain on your current contract and pay. You have until the 30th of September to express an interest, i.e. you have until Thursday to express an interest in whether you want to move to one or other of the contracts. And that will be anything beyond that will be at the discretion of your trust, and there would be no right to back pay to April 2021. I will come back to that in a couple of minutes. The specialist grade entry criteria, these apply to associate specialists expressing an interest in moving over currently. They also apply to new appointments into the specialist grade in the future. So important things to note: the employer identifies the need for a specialist role, and that role then would be advertised, and you would apply either within your current trust or in another trust, apply for the role, and people will be interviewed and selected on the basis of the criteria which have been set out. Now, there's a generic capability framework set out on the NHS Employers website. It requires a minimum of 12 years medical work, including 6 in the relevant specialty within the SAS grades. There are also those capabilities around the issues that are set out there: leadership, professional values, etc., education. The crux for most of you, I suspect, is in deciding which contract you want to be on will be pay. So the Specialty Doctor Contract 2008 has these pay scales. So you have 11 pay points, you have 2 thresholds which you have to pass to be able to progress. The second being slightly more onerous than the first, and it takes you a minimum of 17 years to move from the bottom of the scale, 41,158, to the top of the scale at just over £76,500. They are the salaries as at 31st of March this year. The new contract looks very different. There is a 3-year transition to reach these salaries, so these would eventually come into play for April 2023. We have, instead of an 11-point scale, simply a 5-point scale, starting significantly higher, moving from just over 41,000 currently to, by April 2023, being a salary of £51,000. And rising to a maximum of £80,000, which is slightly higher than the current salary. You would normally be expected to spend 3 years, or that's the minimum length of time on each pay point, which means you can progress to the top of the scale in 12 years compared to the previous 17. That combination of higher salary in the early part of your career and faster progression makes the pay scale sort of more compatible, if you like, or more beneficial now that you're on a career average pension scheme rather than a final salary pension scheme. You're accruing more pension earlier in your career. Pay progression is standard. Essentially, if you've engaged with the job planning process, appraisal, made every reasonable effort to complete mandatory training, no live disciplinary sanctions, you would progress from the minimum of the scale to the penultimate point without any further assessment. The move to the final point, to point 5 on the scale, requires you to have be working at a more independent, more without supervision, and contributing to wider role beyond just service delivery. So that be that in management, be that in teaching and training, or service development, audit, all the things that are set out there. I think importantly to stress is that the employers are obliged to provide and support the development you in the development to allow you to progress, so that as you're approaching that maximum pay point, you should be given opportunities to meet the criteria which would allow you to progress. So let's look at the specialist role, the more senior of the two. So this is the current associate specialist pay scale, again at 31st of March 2021. Again, 11 pay points, 2 thresholds, and a minimum of 17 years to progress from the bottom to the top. The minimum salary is 57,000, rising to a maximum of 95,000. Under the new contract, that looks very, very different. So only 3 pay points, a starting salary, as again stressed by April 2023, of £81,500, a significant increase, and rising to £92,500 at the top of the scale, which the eagle-eyed amongst you will have noticed is about £2,500 lower than the current maximum salary. And of course, because the grade has been closed since 2008, most current associate specialists will be at or close to the maximum salary of the new grade. That means there will be pay protection if you choose to move over to the new contract. So you will not lose pay, you would be protected until such time as your as these salaries progress over and above the salary on your 2008 contract, which may take some time or may in fact not happen, but you would be protected. Again, there's a minimum length of time on each pay point of 3 years, which means instead of 17 years to reach the top of the scale, it can take a minimum of 6. The progression criteria, however, are a little bit more onerous than they are for the specialty doctors. Again, you have to meet those usual contractual standards around job planning and appraisal. But in addition, you'd have to undertake multi-source feedback, perform a full audit round, demonstrate both your own learning and an ability to deliver learning to others by completion of clinical or educational supervisor training and or delivery of workshops and lectures. Importantly, again, as with the specialty doctors, there is an obligation on the employer to provide opportunities to support that development, to allow you to progress through those scales. As I've said, there is a 3-year transition period, and you can look at your individual pay journey, as they're called, on the NHS Employers website, and they have been updated to show the effect of the 2021 salary increase. So what has happened? I'll put a so this is the progression that would happen normally. So this is a specialty doctor, early career, minimum of 1 year's experience, who would have been earning £44,677 at the progression date, at the implementation date of April. You would move over to 45,124 on changing to the new contract. At your incremental date, in that year, you would move to the 49,745. That then progresses to just over 50,000, with a further increment taking you to nearly 57,000. And finally, the salary changes to get you onto the new scale by April 2023 with a salary of 58,756 as it currently stands. So from earning 44,000 now, you'd be earning close to 59,000 in a couple of years' time. However, what has happened with the pay award for 2021 is that the 3% has been applied to the salaries on the old contract, but not to salaries on the new contract. And that is because as you can see, there is already significant investment into the new contracts built into this pay progression. It works out at 3% a year across the board. This example here, that the increases are greater than 3%, at others they're not quite as large. But the impact of that 3% being applied to this set of salaries here is that 44,677 has now increased. I don't have the figure in front of me, but to a figure above the 45,124, which means that were you to move over immediately, you would have a drop in salary, and it applies at most of the pay points. So what it's created is a disincentive to move over at this time. The BMA and NHS employers have been trying to find a solution to this, which would have extended the period in which you could express an interest beyond this week, beyond 30th of September. That has not been successful at national level, and those of you who are BMA members will have been written to yesterday explaining this and explaining what may happen. Discussions are continuing, and the advice in the letter that's been sent out overnight is that if you were seriously considering expressing an interest in moving over to the new contract, it would still be worth you doing so. You have somewhere up to 3.5 months before you would have to make a final decision, by which time there may be some greater clarity on this situation. As I say, the letter, if you're a BMA member, you'll have received that. Have a read. It gives all the details. In this instance, because there is clearly some significant benefit in moving to, in the longer term, you may think it's worth moving, but look at your own individual pay position before making that decision. These slides simply go through in words what I've just shown you graphically. And again. So just very quickly, I will just go through some of the other changes that are in the new contracts. The on-call availability supplements, and for those of you who do non-resident on-call, have been increased, at least for those of you who normally have to return to the hospital, and they've been brought in line with consultants. If you do category B work, you normally only have to give phone consultation and are not typically required to return to the hospital, then there will be a slight decrease in your availability supplement. There are some issues around job planning. Plain time has been extended from instead of 7 AM to 7 PM on weekdays, is now 7 AM to 9 PM. So if you do a significant amount of work between 7 PM and 9 PM, that's currently paid at time and a third, now would be paid at plain time. So if you do a lot of work at that time, you may want to look at the implications of that. However, it's not an open book for employers to simply change your working pattern. Any changes you have will have to be agreed through job planning. The right of current associate specialists to refuse elective work in premium time is not in the new contract, so that's been removed. And we have the minimum of 1 SPA, which is already in the contract, is still there, but now it's been tightened up and should be used solely for what I might call your own personal development. There are also some safeguards, so no less than 60% of your time should normally take place in standard working hours, unless you agree otherwise. The maximum number of weekends you can work, whole or part, is set at 13, or 1 in 4. And elective work should not be scheduled normally to finish later than 9 p.m. For those of you working full shifts, there are safeguards: no more than 4 consecutive night shifts, no more than 4 consecutive long days, and a 46-hour rest period between working days and nights. Also, there's a limit of 72 hours in which you can be asked to cover for an absent colleague before alternative arrangements have to be put in place. Also, other key changes, perhaps the ones to stress most importantly, 1 day's additional leave after 7 years in the grade, some additional development funding, which is part of the contract. So you can read those. Certainly a clearer distinction between responsibilities for specialty doctor and specialists. That's an important one to consider, and introduction of an SAS advocate role, a sort of champion for SAS doctors. The implementation process, very quickly, you will have been written to, and you have, as I said, until Thursday to express an interest. Then you have to start a job planning process, which can take up to 3 months, to look at what your new job would be, taking account of some of those safeguards and changes to availability and working hours and things like that. And then the trust will offer you the job plan and a salary package in writing, and you have 3 weeks, 21 days to accept or decline that. And you would move to the pay point as the transition tables. As I said, importantly, given the confusion and the difficulties created by the pay award, there's no obligation to sign a new contract, but you would have probably until middle to late January to actually make a final decision, by which time the position may be clearer. So I think my suggestion is, if in doubt, put in an expression of interest to move over. I mean, just summing up really some of the pros and cons and what you've got to do. I can't tell you whether to move over or not. It's very much an individual decision. But have a look at some of the detail on the BMA website, on the NHS Employers website, before making that final decision. Okay, and then your reasons to join the BMA, and the QR code on the bottom of that slide, which you can scan to get your free first month of membership. Okay, well, thank you very much for listening. If anybody either listening now or watching this subsequently, feel free to contact me on rharrison@bma.org.uk with any questions. And well, thank you for listening. And I would just like to hand over to my colleague from the BMA's financial advisor partners, Chase de Vere, to Suzanne Allport. Thank you very much.
Thanks, Robin. That's great. Super. So good afternoon, everybody. My name's Suzanne Allport. I'm one of the business development consultants at Chase de Vere Medical. And as Robin explained, we work in partnership with them to provide specialist financial advice to BMA members. And this afternoon we're going to run a short pre-record that's going to last about 30 minutes, talking to you about the essential financial planning tools for SAS doctors. So I'm going to attempt to share this with you now. If you do have any questions, please do feel free to get in touch, and I will share with you how you can do that at the end. But I'm going to share the presentation with you now, which will take just a few seconds. And then I will also go on mute during this. Okay, thank you.
Hi, sorry, Suzanne, the sound's not coming through.
No problem. Let me just see if I can fix that for you. Sorry about that. One moment. I'll just start us at the beginning again.
Thank you.
And I will. Could you just let me know if it is, if that's okay?
Yeah, will do.
Okay, let's try that. Thanks, Zoe.
Okay, so what we've got.
That's working now. Thank you.
Financial planning for the SAS doctor. So the agenda, I'm going to go through just the very basics of the NHS pension. I'm not going to go into loads of details there, just to explain that so you can try and understand how that works. Then I'm going to talk a little bit about the government response to the changes to the transitional arrangements in the 2015 scheme. And again, I'm going to go fairly high level on that. The BMA themselves have done a number of quite detailed webinars on that particular issue, but I just want to make sure you have a good high level understanding of the impact that will have on yourselves and the pension scheme. And then going to touch on taxation basics, pension taxation basics. With the new contract, there's a small chance that some of you may be impacted, and that may push you into the bracket of something called annual allowance tax, and some of you may also then, with the higher level of earnings going forward, push you into the lifetime allowance bracket as well. So explain how that works. And then we're going to a small session around reviewing your protection, making sure you have the right levels of protection in place as a SAS doctor, and income protection, critical illness, life insurance. Tell you a little bit about ourselves, Chase to Vere Medical, and then finish with hopefully a good question and answer session. So that's how I see the day working out, and it should be probably about 30 minutes, I would have thought. So we'll start off with the pension, and the first thing I always mention is about the total reward statement. And this is a document which you should all have access to, which will detail your employment package and the value of your employment package, including details about your pension. And if ever you sat down with one of Chase to Vere Medical's financial advisors, the first question the advisor would ask, someone like Paul would ask you, is, have you got your total reward statement? So hopefully you're registered for that. If you're not, it just shows you there how you can view your statement and how you can get registered. It's under the electronic staff record. But I recommend the first thing you do, if you haven't yet done so after this webinar, is get yourself registered for your total reward statement. It's a very painless process, but then you can access things like what your salary is, what your pensionable pay is, how much you're paying to your pension each year, and what your pension is worth. Okay, so that's a really important document for you to get registered for. When we're talking about the pension, the NHS is quite complicated. Now, I'll change that. It's very complicated. And it makes things quite difficult for people like yourself and members of the NHS pension. And you have to study it to really understand how it impacts you. Now, there are two pension schemes, but under one of the schemes, there's two sections. So you've got the 1995 section, 2008 section as one scheme, then you've got the new 2015 scheme. I'm going to start on the left-hand side of this slide and just mention about first the 1995 section. And the 1995 section is based on what we call a final salary pension. And if you join the NHS pension before the 1st of April 2008, that's the pension you would have joined the 1995 section. It's a 1/80th accrual rate, which means for every year of service, you build up 1/80th of your final salary as a pension. So if you completed 40 years service, you had 40/80ths, half your final salary as a pension. Now, the great thing about that scheme also, it has a retirement age of 60, and you get an automatic lump sum of 3 times your pension, which is tax-free. You also had the option to purchase something called added years, where you could top up your pension. Really good benefit, really good value for money. You can't now purchase added years. You had to have done that before the 1st of April 2008. But you can still purchase up to £5,000 a year versus our worth of additional pension on top of that, if you so wish, within the 1995 section. And then the second section of that scheme was for those individuals that joined between the 1st of April 2008 and the 31st of March 2015. And if you did that, you would be a member of the 2008 section. And looking at when you talk members of the NHS pension scheme, there's quite a few of you that will fall within that bracket. And that scheme, again, was based on final salary, and it was what we call a 1/60th pension scheme. So if you completed 40 years, you'd get 40/60ths of your final salary as a pension. So 2/3 sounds better. However, the downside of that scheme, you had to wait till you're 65 to draw your pension without any kind of reduction. There's no automatic tax-free lump sum, and there were no added years available. But you could still purchase additional pension if you so wished. Now, it's worth pointing out, although it says retirement age of 60 and 65 for those two sections, you can draw the pension any age from age 55. And in fact, for those individuals who joined the scheme before April 2006, you can in fact draw your 1995 section from the age of 50. Okay, so you can draw early, but there will be a reduction in the penalty in the pension that you'll receive. Now, for individuals who joined from the 1st of April 2015, you'll be a member of the 2015 scheme or the CARE scheme, the career average scheme, so no longer linked to your final salary. Now, it's worth pointing out that individuals would have moved over to the 2015 scheme depending on their age on the 1st of April 2012. And those individuals who are within 10 years of their retirement age actually would not have joined the 2015 scheme. If you had more than 10 years but less than 13 years and 5 months from your retirement age on the 1st of April 2012, then you would have moved into the CARE scheme at a date in the future. And for all those individuals who were more than 13 years and 5 months from their normal retirement age, you would have joined the 2015 scheme on the 1st of April 2015. So a little bit complicated, but hold that thought, because I'm just going to add to that shortly in respect of the recent government announcement. Now, this is a 1/54th accrual rate, and what that means is you get 1/54th of your salary each year built up towards your pension. So if you're earning £54,000, you get 1/54th of £54,000. You get £1,000 pension for that year's worth of pension contribution, and that goes in a pot. So say you're earning £54,000 the next year, again, that £1,000 will go into a pot. And in the background, that pot keeps growing each year at a rate of CPI plus 1.5%. So it's revalued. Now, CPI is Consumer Price Index, a measure of inflation, plus you get that additional 1.5%. So hopefully keeping your pension growing ahead of inflation. So that's a pretty good growth rate you're getting on your pension in the background. Of course, there's always a downside. And the downside with the CARE scheme is the retirement age is in line with state pension age. And then again, there's no automatic lump sum. Now, it's not linked to final salary. So even in the early stage of your career, when you're earning less income, that will still count towards your pension, which it won't do, obviously, in the old final salary scheme. Now, there is additional pension available under the CARE scheme, the 2015 scheme. You can actually purchase up to £6,500. So you can purchase a little bit more on that basis. And at the bottom, there's something called ERBO, Early Retirement Reduction Buyout, just so you know. That's also available under the scheme. And what that allows you to do is actually draw your pension earlier than state pension age. And you can buy out pension so that you can draw your pension without penalty from age 65. So it's a bit different, the CARE scheme, but the benefits under it are still really good. And for most members of the scheme, the benefits are still going to outweigh anything you could get by a private arrangement. Now, for real high earners, is a concern, and I'll touch on that shortly. But for your average doctor in the middle age of their range of earnings, and certainly from a SAS perspective, both schemes are extremely good value for money. However, and I mentioned there would be an if, there has been a change to the scheme, and particularly to the 2015 scheme. And what happened, I mentioned earlier about this within 10 years of retirement, you won't have to move to the 2015 scheme. And then there's this, if you're 13 years and 5 months or 10 years from retirement, that period, you join at a later date. Well, actually, there was a problem with that. And the government have been forced, due to the fact that broke age discrimination laws, in fact, to change the basis of the scheme. Okay. Now, the 2015 scheme, just to give a bit of background, it was introduced because the costs of the NHS pension scheme were extremely high. But they're mainly due to longer ages into retirement, people living for longer. So what we're hoping will happen with this scheme was it would try and make the cost lower by paying the pension later, i.e. state pension age. Okay. As I mentioned, part of this tapering of moving into the 2015 scheme was an issue from an age discrimination point of view. You can't make decisions on pension schemes based on individuals' ages. It's against the law, and that was the main issue. So those issues of, you can or you can't join a scheme based on your age just cannot be done. This is where this change has all come about. So a consultation was put into place, and the courts ruled that, as you mentioned, it was again, as I mentioned earlier, it was against age discrimination rules, and therefore they needed to change the rules around the scheme. Now, it's worth pointing out that the introduction of the 2015 pension scheme in itself, the care scheme itself, is not deemed as discrimination. It was that rule around when people were forced to join the scheme. So a judgment has come out from the 4th of February 2021, and anyone who was serving or a member of the pension scheme on or before the 31st of March 2012 will be in scope for the proposals I'm just about to explain. And that includes maybe individuals who maybe deferred from the pension scheme, even retired, or even those ones who had qualifying breaks in service, but it had to be less than 5 years. Okay, and these changes will happen automatically. You won't have to actually do anything yourselves. So what the government have decided to do to make it as simple as possible, and it isn't simple, believe me, is to say, right, in order to deal with the age discrimination issue, what we're going to say is that everybody who's been forced to move into the 2015 scheme actually will be returned to their old legacy scheme, their 2008 or 1995 scheme, for service between 2015 and 2022. And then what will happen when your benefits become payable, so you actually get to the stage of retirement, you'll receive a choice whether you'd rather the benefits remain in the old legacy scheme, or you prefer between the 2015 and 2022 for those benefits to be put back into the reform scheme, the 2015 scheme. So it's the best of both worlds. So it's a good outcome for most individuals who are in the pension scheme. It's just making things a little bit more complicated. Hopefully this diagram might try and help explain it. So if you join the NHS pension scheme after April 2012, or the 31st of March 2012, then you don't have to worry about these reforms. They won't affect you. It only affects the period between April 2015 and April 2022. So what will happen, anyone who's joined the 2015 scheme during that period would have their benefits put back into their legacy scheme, their 95 or their 2008 scheme, and then they'll just carry on from April 2022 in the 2015 scheme. Then when they reach retirement, they'll then have a choice what to do with their benefits in that 7-year period between 2015 and 2022. And that's it in a simple nutshell, if you like. But obviously the mechanics of it are a little bit more complicated. If you're due to retire before April 2022, you can still go ahead and do that, but you'll be put as a priority in respect of sorting this situation out. The biggest impact are going to be on those individuals with annual allowance taxation issues, and we may have some SAS doctors who have been affected by the annual allowance taxation, and if that is the case, then it's a good chance that this ruling will mean that your annual allowance liability will be reduced. So there's some good news. So if that's the case, then there will be action you'll need to take. You will have to recalculate your annual allowance tax situation and make sure that that is submitted as per a process which will come out hopefully within the next couple of years. At the moment, though, again, just want to reiterate, you don't have to do anything in respect to this at this moment in time. Okay, you will be contacted by the pension schemes and they'll let you know what the new inputs are from an annual allowance tax perspective, so you can do the necessary calculations. But this does require new legislation. It can take a number of months for that legislation to be put in place. But keep an eye out, and obviously people like the BMA and ourselves, be stuff on our website, will keep you informed of what's happening. So that's the legislation changes, and they are quite complicated, but hopefully I've tried to put that in sort of 3 or 4 slides quite simply. And as you said, with the BMA, they did some fantastic webinars, but it was over a number of hours, and that's how complicated it can be. I mentioned pension taxation. I just want to cover just the high level facts, because with the contract changes and hopefully an increase in income for many of you, then just be aware that you may be dragged into pension taxation, which is in some ways, means that your pension is going to be increased, which is good, but also it's something you need to think about, where you need to plan around. I'll start on the left hand side with 40,000, which is the annual allowance. And just again, just high level to explain, £40,000 is the amount of pension growth within the NHS an individual can have before potentially incurring a tax charge in any one tax year. If they're paying into a private pension, so if you have things like ABCs or personal pensions, it's the actual contribution you're making which will go on top of that as well. If you're a high earner, so for example, if you're earning over £200,000 after removing your pension contributions, then you may find that your annual allowance is reduced. There's a couple of checks you need to do in respect of checking that. So if you're at that, if you really are at that level of earnings, then I would recommend you have a word with one of our advisors just to see whether you have the full £40,000 annual allowance. And the other good news is you can always carry forward up to 3 years of unused annual allowance as well. So there's that opportunity as well. The other tax, pension tax, is the lifetime allowance, which is currently £1,073,100. This has just been frozen following the last budget. Used to increase by the consumer price index, but now it's been frozen at this figure until April 2026. And what that is, that's quite simply the value of your pension pot. And if it exceeds that figure, you can be taxed. The tax rate is up to 55%, basically if you took the excess of the lump sum. Now, just to again put it in perspective, just to explain how that works. If you registered for your total reward statement and you're a 1995 scheme member, if you times your pension by 20, add on any lump sum and add that together, if that comes to more than £1,073,100, then it means you've exceeded the lifetime allowance. If you've got any private pensions, you need to add those on top as well. So, but again, if there's anything you're worried about there, please do speak to one of our advisors. I'm more than happy to help you. But you're probably going to find more SAS doctors being potentially dragged into this over time. So that's pensions, pension taxation, and what they call the McLeod judgment, the government consultation. It's becoming increasingly complicated. But I'd recommend if you're unsure about how you are with your pension, please do speak to one of our advisors. But what we're talking about now is maybe looking after yourself from a protection perspective. It's been obviously a horrendous year, and you guys have been right at the forefront of it. We really do thank you for what you do. It's amazing, unbelievable what you guys have done. But it does worry me sometimes that you've looked after everybody else. Have you really looked after yourself and your family? I'm just going to spend a few moments talking to you, making sure that you have looked after yourself and your family if the worst was to occur, and just explain what support you'll get from things like the NHS and what maybe you need to put in place yourself. So the most important financial asset, what is your most important financial asset? Well, it's not your house, it's not your car, it's you. It's your ability to work, because if you're not working, you're not bringing in a stable income. So make sure you are protected, you are insured. I see too many doctors still not sufficiently insured. You got to think about, your income pays for your housing, your family, your lifestyle, entertainment. Hopefully we'll have some more of that back following, now we're easing out of lockdown. But it also supports things like your future plans and aspirations. People forget about that, forget about their children through university. If you've maybe got children at private school as well. You forget about the costs in the future that your income now is going to pay for. So you need to make sure you have enough protection. So first of all, from an NHS perspective, if you're off sick, this is what the NHS provides you. And I know there's a few people watching today who haven't been with the NHS for 5 years. So you can see that as your service increases, your protection increases. So once you've completed 5 years service, you get 6 months full pay and 6 months half pay in respect to sick pay. If you've only completed 2 years service, you're only protected for 4 months full pay and 4 months half pay. So what do you got to think about? What happens once this ceases? What happens once your sick pay finishes? So if you're seriously ill and you get to the end of 6 months, can you afford for your pay to be cut in half? You get to the end of 12 months, can you afford to rely on the state? So there's a couple of things. First of all, being a member of the NHS pension scheme does provide you with an ill health retirement pension potentially. And it's a two-tier system depending on the severity of the condition. So there's a tier 1, and that's where you're assessed as being unable to undertake current duties. Then there's a tier 2, where you're assessed as being unable to take any regular employment, so a more serious condition. The important thing here is that in order to claim an ill health retirement pension, it must be of a permanent nature. I always use the example, we had a client a few years ago who had a mental illness, and it took them 8 years to prove that that mental illness was of a permanent nature and affecting them being able to go to work. During that 8 years, they didn't receive any kind of income because their sick pay had finished. And then once they were able to claim their ill health retirement pension, it was only on the basis after that 8 years. So in that period of time, they'd had a lot of time where they'd had to rely on the state for any kind of income. It was a pretty sad situation. But proving that permanency of the condition is quite tricky. And the difference between the two tiers, tier 1 is that you can claim a pension that you've already earned without reduction. So if you've done 20 years service, there's 20 years worth of pension. Whatever's accumulated to date, you can claim that as a tier 1. Then tier 2, which is a more severe condition, what would happen? Any pension you've accrued to date, your tier 1 pension you'll have, but then also you'll have an addition to that pension based on prospective service. So to give an example, if you're in the 1995 section and you've got 3 years to go into your retirement age, then you can claim 2/3 of that prospective service. You can get another 2 years worth of pension added onto your tier 1 basis as a tier 2 ill health retirement pension. You see with the 2015 scheme, it's half of prospective pension to pension normal pension age. So if your state pension is 68 and you were 48 when you claimed your tier 2, then 20 years to go into your state pension age, so therefore you could claim another 10 years worth of pension enhancement. So your pension will be increased by another 10 years worth of service. So it's quite a valuable benefit, but as I said before, getting tier 2 is quite tricky to claim. So I'm not going to go through this much. I've already mentioned about the fact, that it is permanent. You have to be permanently unable to work. You need to prove that. It's quite tricky. So what you need to think about is if you're unable to claim ill health retirement pension, what do you need to do? Well, you need to make sure that you're protected, your income is protected with an income protection insurance. Again, as advisors, we can help with this, but this is what I consider to be the most essential of all the financial planning tools. Every SAS doctor should have income protection, and what that will do, it will pay out. Doesn't matter what the condition is. If you've got a condition that stops you from working, therefore earning, this income protection policy will pay out. It doesn't have to be of a permanent nature. We recommend you look at things like an own occupation basis, which means that if you can't do your job as a doctor, this policy would pay out. Link it to inflation, obviously, but make sure that you review the policy on a regular basis as well. So some of you may have this in place, which is great, but have you reviewed it recently? Is it still covering your income as it increases? Obviously, with the new contract, some of your pay may change, so you need to think about, how does that affect your existing insurances and get them in place. But income protection is extremely important. And I'd recommend that every SAS doctor has that insurance in place, and it covers them up to their normal retirement age. The other insurance you need to think about is, I mentioned about, the income protection paid out if you're unable to work for a period of time. But we also recommend talking about things like critical illness. And what critical illness does, it provides you with a lump sum. And what that lump sum it does, it will either pay off your mortgage if it's there to protect your mortgage, which is great, or it gives you life decisions. You can make life decisions. So it may be that you've been off sick, you don't want to return back to work full time when you're well enough. So therefore you have a critical illness policy, provides a lump sum to supplement that income. It may be while you're off sick on the long term, you can't fund your pension. So again, critical illness gives you a lump sum of money that you can help make up for that pension shortfall that you're going to have because you've not been able to contribute to your pension. You may want to modify your home. You may have family abroad that you wish to visit to recuperate. So that's what critical illness cover gives you. So the main cover it covers you for is for heart attack, stroke, and cancer. They're the three main ones, but it covers usually sort of up to 30 or more conditions. But I would say that the vast majority of claims are for those three conditions. The important thing is it's critical, so it tends to be linked to an illness which is critical, so life-threatening. But it's extremely valuable cover, and sometimes it is underrated, I have to say. But I've paid out some good numbers of critical illness policies. It has made a difference to those individuals. Then finally, we're talking about death benefits, a lump sum on death. So again, working for the NHS, your family would be entitled to 2 times your pensionable earnings as a lump sum. The definition is slightly different depending which scheme you're in, but that's assuming you're a member of the NHS pension scheme. If you're not a member of the scheme, you've left the scheme for some reason or deferred or decided not to join it, there's still a lump sum based on your membership to date, but it's slightly less. You can see at the bottom there, 95 scheme section, it's 3 times pension payable. 2008, 2.25% pension payable. 2015 scheme, 2.025 times pension payable. So slightly less payouts than an active member of the pension scheme. And also, the important thing is, as well as the lump sum, it also provides dependent benefits on death, and these are important. So dependent benefits are payable to a spouse, registered civil partner, nominated qualifying partner, also to dependent children as well. You need to have completed 2 years membership for the dependents pensions, but as you can see now, the conditions have extended in respect of it's more than just a spouse. You can have civil partners or nominated qualifying partner, which means they're financially dependent on you and have been for at least 2 years, can also claim dependent benefits. So it's quite an extension there. And what is that benefit? Well, we mentioned earlier about the ill health retirement pension previously, where you've got the enhancement. Well, a nominated partner, spouse, would get 50% of the Tier 2 ill health retirement pension in the 95 section, 37.5% in the 2008 section, and in the 2015 scheme, it's 33.75%. So if for a young doctor, particularly, that enhancement is quite significant. Remember I said, talking about a 33.75% enhancement. Doesn't sound much, but if you've got a young doctor in their 30s passes away, then there's another 38 years to their normal retirement age. So have another 18 years, about another 13, 14 years worth of enhancement on their pension for their partner. So it's really quite important to build that benefit into any calculations that you're making for protection for your family. And dependent children, I mentioned that before, it works out there as half of the benefit payable to the spouse. So 25% of the notional Tier 2 ill health retirement pension 95 section. Again, that's 50%. If there's 2 children, then you get double that amount. If there's more than 2 children, it's capped at 2 children. And you see there, 2008 scheme, 2015 scheme, again, it's 50% of the spouse's benefit on the previous slide. So that's just giving you a really quick high-level overview. But the important things when you go away from today, I want to make sure that you've got things like your mortgage and liabilities are covered for death, definitely, and ideally diagnosis of critical illness. Make sure you've calculated the correct level of any life assurance, critical illness income protection cover you would need. We're talking about life cover as well. Make sure that you've built in the benefits you'll get from the NHS. The NHS itself won't provide most families with enough cover in itself. You will need top-ups to that, but again, we can accurately help you calculate how much cover you would need, and give consideration please to the NHS pension scheme as well, and what that's going to provide you, and whether you need extra planning around that as well. But a primary objective of any financial advisement, what we're talking about today, is that if anything was to happen to yourself, it maintains any dependent standard of living, both now and in the future. That's really the goal. And we're talking about yourself, but also think about if your partner was to pass away, what impact that would have on you and your family as well from a financial perspective. So I'm just going to touch very briefly about Chase to Vere Medical and how we can help you. So we've worked with the BMA now since 2005. We do have specialist financial advisors like Paul, who are trained to give advice to medics. We're independent, which means that we go to the marketplace to find solutions for our clients. We really can find the best solutions for our clients in the marketplace, unlike a lot of other companies who aren't independent. and we provide holistic advice. So I've talked about today very much around sort of protection of the pension, but it may be you needed investment advice, savings advice, inheritance tax advice. We can provide all that for you as a complete package. And how it works is you meet with one of our advisors via an introductory meeting. Usually takes an hour and a half. They'll gather loads of information off you. Not very exciting that first meeting, but it's amazing what we find out. And from there, we can really work out what level of financial advice you will need. We can then put together a financial analysis. And then from there, as long as you're happy to proceed, so we will agree a costs with you at that stage, you're happy to proceed, we'll come back with our recommendations to you and hopefully look to put those in place and agree how to review your circumstances going forward.
So that takes us to the end of our presentation slides. What I will do now is just share the QR code if anybody is wanting to speak to somebody at obviously Chase to Vere with one of our financial advisors. You can do that by just scanning the QR code and we can put you in touch with the booking system. So I'm going to do that now. If you just bear with me 2 seconds where I'll bring that up for you. If anyone does have any questions, it is probably best to scan the QR code and you can ask those on a one-to-one basis with somebody. I'm not a financial advisor, so obviously I wouldn't want to give you any information today that was incorrect or not valid for yourselves. Hence why we used our pre-record today. So I'll just find the QR code for you and then bring that up. So if you do want to chat with anybody, please feel free to do so, and we will organise that for you. It will come straight through to myself, so I can book that in for you. But hopefully you found that information helpful today, and we hope to see you at future presentations as well. I'm going to bring up the slide now for the QR code, and there you go. Hopefully you can see that. Let's just see now, 1 second. Bear with me a minute, I think it's frozen. You just advise if you can see that, Zoe. Can you see that?
Not yet. No, not the QR code. Not yet.
Okie doke. 1 second.
Okay.
It shan't be a moment. How's that? Can everybody see that now? So as I said, if you'd like to speak to somebody, yeah, you just scan that code, or alternatively you can email myself at Suzanne Allport at chasetodvere.co.uk. But I really hope that's been useful and insightful, and you've kind of taken a few learns away from today. And just thanks again for having us, Zoe, and organising the day and the training. And hopefully we can see you again in the future.
Thanks very much, Suzanne.
No problem. I'll stop sharing that now.